right, everyone. Hello, welcome, and thank you for joining us today. Without further ado, it's my pleasure to introduce Jim Welsh. He's a 40-year market veteran and macro and technical strategist with Macro Tides, where he covers stocks, treasury bonds, dollar, and precious metals. The cornerstone of his tactical strategy is the intersection of economic fundamentals, monetary, and technical analysis. To our live viewers, please feel free to type any questions you may have into the chat box, and time permitting, we'll try to get to those at the end. With that all said, Jim, I'll hand the mic on over to you. I'll be right here if you need anything, but the floor's all yours.
All right. Thank you, Charlotte. And thank you for participating in my presentation. I appreciate you taking the time. And in 30 minutes, you're going to be glad that you did. Monetary policy is key to identifying trends in financial markets. And therefore, I could say, well, I'm an expert at monetary policy, but instead I'm going to give you an example. In January of 2022, Goldman Sachs and the majority of Wall Street firms were looking for the Federal Reserve to increase the funds rate 3 times in all of 2022, so that at the end of last year, the funds rate was going to be at 0.75%. Now, they were saying this despite Chair Powell saying that inflation wasn't transitory. That was in November of 2021. And the CPI had ratcheted above 7%, was at a 39-year high. So despite knowing that information, Wall Street was still only looking for 3 rate hikes in all of 2022. In the January 17th weekly technical review, I said that the FOMC would likely front load rate increases and increase the funds rate at the March, May, and June meeting. As we all know, the Fed did exactly that. The S&P subsequently declined from 4,800 down to 3,850 or 3,650 in June of last year. So why did Wall Street get it so wrong? I think if you go back to 2000 to 2021, the core CPI for that whole window of time, as well as the Fed's favorite inflation metric, the Personal Consumption Expenditure Index, hovered right around 2%. What that meant is the Fed had the flexibility to respond quickly whenever the economy started to slow or the financial markets started to act disrupted, like in late 2018. The Fed could lower interest rates. So if you're on Wall Street for 20, 25 years, your experience has been that the Fed comes to the rescue every time the economy slows or the markets start to tumble. And what Wall Street failed to realize is that with inflation at a 40-year high, the Fed has to employ a completely different metric than the one that they've been using over the last 20 to 25 years. And I think Wall Street still has it wrong today. In addition, we're going to look at Wall Street's expectation for the economy last year. And what we're going to see is that Wall Street got that wrong as well. So last year, what we can remember, in the summer of last year, there were 2 consecutive quarters, first and second quarter of last year, negative GDP growth. Immediately, Wall Street jumped to the idea that we were in a recession. I consistently wrote throughout 2022 that there wouldn't be a recession in 2022 and elaborated a lot of the reasons. When the economy grew in the 3rd and 4th quarter, Wall Street changed the narrative from, oh, we're going to go to a recession, oh, we're going to get a soft landing. And when the economy started off on a strong footing in January of this year, you had strong employment growth, retail sales numbers were good. Immediately, Wall Street jumped to no landing. We're not going to have a recession. And earnings are going to be up, by the way, over 11% through the course of this year. My take has been that growth would continue through the first half of this year. But as we got near mid-year and beyond, we would see a significant slowing. And I think potentially at least 1 quarter of negative GDP growth in the second half of this year, and potentially a hard landing. And I discussed this at length in my May Macro Tides issue. All right, so why do I think there's going to be a recession when Wall Street is looking for no recession and decent earnings growth? It really goes back to 3 indicators that have been very, very effective, very reliable, and spot on in identifying recessions going back the last 50, 60 years. The leading economic index is a composite of 10 separate individual economic indicators covering the labor market, housing, credit market, credit spreads, and so forth. What you can see is it has dropped in the last 6 months to a level that has preceded every single recession since 1959. The inverted yield curve, which everybody is, I think, at this point in time, very familiar with. What the second chart shows is the percentage of the yield curve that's inverted. And what we know is that it has become extremely inverted in the last handful of weeks. And the probability, historically, going back to the mid-1960s, is a recession occurs when you get above 60%, and we're way above that. Something that doesn't get as much attention, but is, I think, just as important, is lending standards. I started writing about lending standards last November. Why? Because banks increased lending standards in the third quarter, and I figured they would do it again in the fourth quarter, which they did. In fact, in the fourth quarter, 43% of all the banks, and these are the major banks, had increased lending standards. Historically, whenever more than 20% of banks increase lending standards, you have a recession. Now, why does it work this way? The Fed has been raising the cost of money, but the availability, is really left up to the banking system. So as they increase lending standards, and this affects small businesses much more than big companies, public companies can issue debt, issue stock if necessary to raise capital. Small and medium-sized businesses are really dependent on their bank. As lending standards go up, fewer businesses qualify, or at a minimum, not only do you have the Fed rate hikes, then the small banks will add a premium in terms of the spread above the prime rate that the small business is going to pay. And finally, what also happens is, sorry, Charlie, we're just not going to be able to roll that entire loan over. So as lending contracts, it has a negative impact on the economy. As you may remember, in March of last year, Powell talked about a soft landing, and he gave 3 examples, 1965, 84, and 95. In those 3 examples, the Fed did indeed raise interest rates pretty significantly. But look, it may be hard to see, but I'm going to tell you, in 65, 84, 95, banks did not increase lending standards. So the 3 soft landings that Powell referred to, banks continue to lend freely. That obviously is not the case in this current cycle. So what is the scoop? Okay, importance of small banks. I touched on it a little bit. Maybe you don't know some of these statistics. 38% of all lending is done by the small banks, so a significant amount. The key, I think, over the next 12 to 18 months, and I discussed this at length in the May macro tides, is the impact on commercial lending that small banks are going to have. Of all bank lending, small banks do 67% of all bank lending to commercial real estate. As we know, office buildings are down 25%, apartments, malls are down 18 to 22%. So the valuation of commercial real estate has fallen. There's $1.4 trillion worth of loans coming due over the next 18 months. As those loans come due, some companies and owners, property owners, aren't going to get money, or they're going to be paying more. Some are dealing with low occupancy rates. They'll simply walk away. So my point is, the increase in lending standards is not like a light switch. Like, okay, now we're on off. No, what happens is it progressively weighs on the economy as people's loans come due, and now they got to renegotiate with the bank, whether it's large or small, in terms of, are you going to give me the money? How much am I going to have to pay for it? Small banks also big in consumer credit cards, 27%, mortgages, as well as auto loan. So we're going to see a significant tightening of lending standards over the next 6 to 12 months by small banks for obviously the problems that we're seeing. And they're going to be announcing more and more losses because of their exposure to commercial real estate. Now, why has Wall Street gotten this thing so wrong? I mean, they went from, oh my God, we're in a recession, to a soft landing. No, I don't think we're going to have a recession, despite the historical track record of those 3 recession indicators that I just reviewed. The lag times or lead times is really long. So if you look at yield curve inversion, The average is 19 months. They've stretched out to be quite a bit more than that. So the yield curve inverted in July of 2022 of last year. So 19 months gets us towards the end of this year. The leading economic indicator, the average lead time, is about 10 months. It turned negative in November. So we're talking about late summer. And finally, lending standards, the average lead time is about 9 months, and they hit the threshold in the fourth quarter. So that's why I've been saying the second half of the year is likely where we're going to see the weakness become more significant. But what has really delayed, and stretched, if you will, the lag time on these indicators is excess savings. Consumers came into this year still with about $1 trillion or more in savings. The unemployment rates near a 50-year low, wage growth above 5%. In January, 26 states increased the minimum wage. And in January, 66 million Social Security recipients received an 8.7% increase. So what we're seeing is the ability for consumers to spend is continue to come from the incomes that they're getting. But as excess savings get worn down, and they will in coming months, I think we're going to see consumer spending weaken in the second half of this year, which is going to be problematic, obviously, for the economy. Now, the crazy thing is that Wall Street has this idea that we're not going to have a recession, but the Fed is going to cut the funds rate once or twice before the end of the year. This chart on the right shows the Fed funds futures, and it's hard to see the scale on the bottom, but they're expected to peak around, just around 5%, which is likely to be where we're going to be after the Fed hikes today, I think, by a quarter point. But by year end, they're looking for about 50 basis points reduction. It's simply not going to happen, folks. Now, at the same time, they're saying no recession, unemployment's at 3.5%, 50-year low, and yet the Fed and inflation is still way above the Fed's target. Most of the inflation metrics are somewhere between 4.5% to above 5%, way above the Fed's 2% target. So somehow the Fed's going to still give Wall Street what it wants. We got an economic recovery, the labor market's still tight, inflation's still higher than you say you want it, but you're going to cut rates. It's just not going to happen. The Dallas Fed has an inflation metric, and what they do is they trim, they rank all the CPI categories. Who's up the most, which ones are down the most, and they trim, in other words, remove about the 25% at the top, 25% at the bottom. They're looking at the mid-range. CPI or core CPI based on the trim mean has gone from 4.8 to 4.7. So in other words, inflation is going to continue to come down in coming months, but it's not going to get anywhere near where the Fed wants to see it. And the idea of Fed cutting rates, I think, is just really crazy. All right. So as I noted, for 20 years, Wall Street was conditioned to expect the Fed to cut rates right away, as soon as there's times of weakness. But with inflation at a 40-year high, the Fed has a completely different framework. And Wall Street got it completely wrong last year. I think they still have it wrong, as evidenced by the idea that the Fed's going to cut rates in the second half of this year. All right, so what is the Fed's mantra? And Powell has talked about this. A number of Fed bank presidents, governors have talked about, we want to avoid the mistakes of the 1970s. Well, what were they? Well, in the 1970s, when inflation started to tick higher, the Fed would continue to raise the funds rate as inflation continued to go up, only to realize that they had raised rates too aggressively, tipped the economy into recession, which then forced them to cut rates quickly. And the net result is the economy didn't remain in a recession long enough to completely squeeze out inflation. And the net result is from 1965, 72, 74, 78, 1980, inflation kept making higher highs and higher lows. The Fed has said, we don't want to do the 1970s. We're retightened so much that we toss the economy into a recession, and it forces us to reverse course. What they have said repeatedly is we want to get to a modestly restrictive level and then hold it there, because we know all of the rate increases we've done over the last 12 months are slowly but surely going to weigh on economic growth. So if we can pull this off where the economy slows, but not too abruptly, we can avoid having to cut rates, and we can stretch this process out long enough for the unemployment rate. The Fed is projecting an increase next year to 4.6% from 3.5. Anytime the unemployment rate's gone up by more than 0.5, you're in a recession. So the point is the Fed is focused on getting inflation down, and they're using a different framework to handle it. I don't think Wall Street understands that. They think the Fed is going to be cutting rates. The Fed has repeatedly said, if you look at the dot plots and their projections in the December and March meeting, we want to get to 5.1, then we're going to hold it there for all of this year. So what does that mean, for monetary policy? As I said, Wall Street's been conditioned, hey, as soon as we see any weakness in the economy, boy, the Fed comes to the rescue. Not going to happen this time. So what that creates is a window of time where we're going to see weaker economic data, more pronounced slowing in the economy as we get beyond the middle of this year. And yet the Fed isn't going to be in a hurry to cut rates. Powell has said repeatedly, it would be a bigger mistake to cut rates prematurely. So in other words, they're going to wait longer than they have in any time in the last long time, at least a couple decades, in responding, because they want to give the economy time to be slow enough to bring inflation down. That window of time where the economy is weakening, Wall Street then will be forced to cut their earnings estimates, which again are looking for an 11% increase from the first quarter to the fourth quarter in that window of time. And the Fed isn't going to ride to the rescue. I think that creates a window of vulnerability for the S&P. I think that'll be a buying opportunity, but we're obviously not there now. Wall Street is hoping and praying that the Fed will cut rates. Now, the first thing is a pause. I think Powell today is going to, kind of straddle that. I don't think they want to close out their options. So, yep, we're going to raise the funds rate 25 basis points. Yes, we're fully aware of the lag effect. We're aware of what's happening with lending standards. But at the same time, inflation's higher than we want. The labor market's still tight. They want to keep the optionality open. And if they gave a clear-cut message that, yeah, we're going to be pausing here, the stock market would probably react, very positively, and that would lower and ease financial conditions. So I think the Fed is Powell is going to straddle that issue. My point is, I still think the Wall Street is going to come to that conclusion. They're going to pause. That's got to be bullish, right? Well, here's what's happened when they've cut rates. And what we can see is going back to the last 40 years or so, after the first cut, these are the magnitudes of the declines that have happened, anywhere from 5 to 10% in very modest declines. But in a recession, declines are much more significant, 25 to 35%. And when you've come off a very high valuation, and the market was valued pretty high, it's still selling at 19 times earnings right now. So that's when you've had the bigger declines. So Wall Street is hoping for a pause, yippee, and then more importantly, looking for rate cuts later this year. And the only reason why the Fed cuts rates is when things are bad, which is normally not good for earnings. What does that mean for the S&P? Coming into last year, I thought the S&P was going to decline by at least 10% as the Fed raised rates. At the same time, as I said earlier, I thought the Fed would front load rate increases and that we'd see the S&P decline, significantly as a result. One of the things I use from a technical analysis point of view is called Fibonacci retracements. So that if you look at the low in March of 2020 at 2192, the high in January of 2022 at 4818, there's mathematical numbers 382, 618, where you can say, okay, how big was that rally? How much of a retracement are we likely to see? And as we can see, last year, the S&P followed those retracements pretty closely. The 382 was 3815. The S&P got down near that in May and June. Got a little bit below, I think 3650 or so. The 50% retracement, 3505. In October, the S&P got down to 3495 or something. All right, so my point is, if I'm right, that we are indeed going to see significant slowing, Wall Street's going to have to cut earnings. The PE ratio is going to contract from 19 to 16 to 15, some number. That will set the S&P up, I think, for a retest of the October low. And if we really do get a recession, there's the risk that the S&P will retrace down to the 618% retracement of the rally, which is around 3,200. Near term, I think there's a shot that the S&P can get above 4,200. If it does, technicians are going to go, oh my God, look, we got a breakout. the fundamentalists are going to say, well, you know, I believe the market discounts the future, and the market's telling me there isn't going to be a recession. And my take is, if the S&P gets above 4,200, a move toward 4,300-ish, the August high of last year was 43.25, is going to be a great opportunity to sell into that strength. And ideally, I'm hoping for this rally because I think it'll set up a really good short trade. Okay, let's look at the dollar. The dollar rallied from February into early March. Then once the news of the regional bank crisis started to hit, the dollar sold off from 105.88 to just below 101. So far, it's got kind of a double bottom right around that 100.78. I think potentially the pattern was from the February, late January low to the high in March was wave A. This pullback's B. If I'm right, Fed's not going to be cutting rates in the second half of this year. Markets will finally figure that out. That gives the dollar a tailwind, and potentially a rally above 105.88 is coming. That is not likely to be good for obviously emerging markets, other international equity markets, and gold, which I'm going to get to in a second. Okay, treasury yields. From the low we saw last October, I thought we were going to see a pretty significant rally. The TLT, which moves in direction of treasury prices, in other words, as treasury yields come down, treasury bond prices go up, TLT goes up. TLT rallied from under 92 to 1 over 109. The pullback into the low in late February at 98.88 to me was ABC. I recommended buying below 99.66. When it got up around 108, it was time to say goodbye. I thought we'd see a pullback. This past week, I recommended buying TLT once it traded below 103.48, which it did yesterday. If I'm right, what we've seen is a wave rally. All this choppiness since early December is a B wave, and we're about to break out above 110. The target then gets to be 115 to 117. Gold. As you can see, if you look at the chart, 1, 2, 3, 4, 5 up to the recent high of 2047. That's a 5-wave move that to me signals that the longer term trend has finally turned positive on gold. But after 5 waves, we're going to see a pullback for wave 2. How deep of a wave 2? Well, chart wise, 1900, 1920 has been a pivot point for gold over the last 12 months or so. The 382 retracement of the rally from 1616 to 2047 is around 1882. That low we saw in February was around 1810. But the point being is, once this pullback is over, I think we're going to new highs. The rally lasted about 32 weeks. So I think this pullback has the potential of lasting, 8 to 10 weeks. So we're talking out, another month or two before we see gold finally bottom. All right. Markets, people always say markets discount the future. I think it's a bunch of baloney. And I ask you this, in January, the S&P 48.18, everyone, oh, bullish. Yeah, but wait a second, the S&P then fell by 25%. In October 2007, the S&P peaked at 1,500. Was it telling us that there wasn't going to be a housing crisis? It then dropped to 666 in March of 2020. That low preceded the biggest expansion, longest expansion in history. Treasury yields. You can see when they peaked in 1981 at 15.8%. Gold topped at 2070. Then in August of 2020, then gold, and then inflation went nuts. Gold went from 2070 to 1660 last year, even as inflation went nuts. So my point is, markets don't discount the future. Markets are people guessing what they think is going to happen. Sometimes they're right, but when they're wrong, and they typically are at tops and bottoms, you got a problem. So as I said at the very beginning, from the January 17 weekly technical review, Fed will raise in March, May, and June. The table on the left shows that the December Fed funds futures were looking for 3 rate hikes, just like Wall Street in January 2022. And it's always got, well, the market's priced in that too. It discounts everything. So my point is, the next time you're listening to CNBC or reading an article and people talk about the market discounting the future and so forth, please take it with a grain of salt. Markets are trying to guess what is going to come next. And the reality is markets are not imbued with an infallible view of the future. They're made up of people who are more often than not wrong at market tops and bottoms. So thank you. I hope you found this of value, and more than happy to field a few questions, and we'll take it from there.
Absolutely, Jim. Thank you so much. We do have some questions in the chat. I'll start with this one from Michael. He asks, understanding the difficulty in market timing, what advice would you give to your grandchildren about when to increase allocation to stocks from cash to take advantage of your recession expectation?
Well, that's where technical analysis comes in, Michael, because to me, you need technical analysis to identify trends. I've got a whole bunch of indicators that focus on the short term, intermediate term, long term. So, I will hopefully have the opportunity to teach them that they need to learn technical analysis and not rely exclusively on fundamental analysis. So, to answer your question, I think the S&P is vulnerable until we see the other shoe drop in terms of the impact from monetary policy, slowing economic activity in the second half of this year. So I would tell them, wait until the second half of this year before committing any money.
Thanks, Jim. We have a question from Monica. It's a little complicated, so I'm doing my best here. She asks, is it true that the ESG policies put at risk taxpayer money in the Silicon Valley bank loans to companies? And as we just learned about conscious investing, what would you recommend going forward?
I'm not going to answer the first question, part of that question, Monica. It's just fraught with issues that, I'm just not going to do that. Let's take the next question. And I'm sorry, I'm just not going to go there.
No worries. We have one from Mandy asking, what sectors should we invest in or steer clear of in a recessionary environment?
Well, the overall market, if the S&P drops to 3,200, every sector is going to go down. It's just some will go down less than others. So, my view from a tactical approach is I don't want to be in the market if it's going to drop 10 to 20%. So at the end of that decline, what I would anticipate is looking at the sectors that went down less and started to show improvement in relative strength to the S&P 500, because that's where money is beginning to flow. So you need to monitor that. And it's one of those things that's a game time decision. Once, if I'm right, and the S&P drops to retest the October low or to 3,200, analysis of those sectors will be necessary to identify exactly which ones. It won't be things like consumer staples, utilities, healthcare. Those are defensive sectors. So you don't want to look there. You want to look at, every other sector beyond that. If I'm right about the dollar, by the way, having another rally, I think there's a period of vulnerability for the dollar. So I would also be looking at emerging markets and international funds, because they've underperformed the US market for years and years. I think the time is about to come where they're going to do better.
Thank you, Jim. Next question we have from Patrick is asking, how would you suggest regular investors to make adjustments to their portfolios, both equity and fixed income? Excuse me.
Wow. You just have to learn more. You can subscribe to macro types and you'll learn a lot by doing that. Ultimately, I think everyone has to, people work hard for their money. Then they have to learn how to make the money work for them. So I would not rely on Wall Street. More often than not, Wall Street is dead wrong. They're going to reflect consensus. And as I said, what happens at market tops is most people are bullish. At bottoms, most people are bearish. And that's what Wall Street is. They are the consensus. So I would always learn how to become a contrarian. When everyone is negative, it's time to be bullish. When everyone's bullish, you got to start to become careful. And again, that's where technical analysis can help, because it can help identify trend changes when they're breaking down off of a top or bottoming and starting an upswing. You have to have the skill set.
All right, and let's finish off with this question from Patrick asking, do you have any view on REITs in the next 6 months?
I think commercial real estate is going to continue to go down, especially the office. I mean, you know, we've seen a secular change. Employees aren't going back to the office anytime soon. And the problem with vacancy rates that are fairly significant for office, it's not going to improve. So I think there's a washout coming in that space that is going to affect the small banks. And that's one of the reasons why I think in 2024, the risk of a hard landing has indeed gone up. So one thing I want to do, if I can, real quick before we finish, is okay. Show this last screen here, if I can, Charlotte, very quickly. Okay. For those who are interested, I have a special report called The Coming Secular Bear Market. If you'd like it, send me an email, jimwelshmacro@gmail, and I'll send it out to you. I think you'll find it interesting. I think the next 10 years or so are going to be particularly challenging for investors. And this piece goes into why and what you can do about it.
All right, Jim, thank you so much for a fantastic presentation and for answering those questions. To those of you in our live audience, I did post the email into the chat if you'd like to copy and paste it.
Thank you so much, Charlotte. And thanks again for those who took the time to listen in.
Absolutely. Such a pleasure to have you on. It was really very informative session. Alrighty, everyone. I hope you enjoy the rest of your day and be sure to stay tuned as we do still have more in store for you. All right, take care.